Welcome to The Long and the Short, a show where you can expect an honest take on trading, something you won't hear elsewhere. I'm your host Sandeep Rao. In the last episode, we broke down what trend following really is and how Richard Donchain, often called the father of trend following, helped shape systematic trend following as we know it today. We even tested some of his ideas right here on Nifty. Today we are taking that a step further. I'll walk you through how to build a simple trend following system that actually works. And to do that, we'll focus on two key concepts: trading time frame and trend identification. Time frames are actually the price intervals that you trade, and trend identification approaches are about methods and indicators that can be used to identify a trend within a given time frame. All of this once again using Nifty as a playground. Alright then, let's dive in. Like I always do, a bit of a side story from the world of astrophysics. Incidentally, I'm reading the book Astrophysics for People in a Hurry by Neil deGrasse Tyson. In it, he describes how supernova explosions happen. Most stars spend their whole lives just burning quietly like a candle that never goes out. Inside them, tiny atoms crash together and make light, and that's what keeps them shining for millions, even billions of years. That's what the sun is doing right now, just glowing steadily, a slow and steady burn of sorts, while keeping everything on planet Earth alive. But some stars are much bigger than our sun, so big that they live fast and burn out young. When these giant stars run out of fuel, something amazing happens. These stars can no longer hold themselves and they collapse, exploding into what scientists call a supernova. It's like a massive boom. That explosion to me feels a lot like a breakout, sudden, powerful, and impossible to ignore. That steady burn that happens before the supernova, well, that's like a moving average, slow, persistent, quietly building momentum. Markets tend to work the same way. There's a long stretch of gradual process, then boom, a breakout. That gives us two ways to catch a trend. If you want to ride the slow build-up, moving averages are your friends. If you'd rather wait for the big moment, that's where breakout tools like Supertrend come in. Of course, there are many ways to capture breakouts. Any channel or range-based indicator will do. I just prefer Supertrend because it reacts faster than most and catches the move early. Even if you look at the research and literature around trend following, almost all of it comes back to these two fundamental methods. Take the book Following the Trend by Andreas Klenau. I'd call it the manual of systematic trend following. He dedicates an entire chapter to comparing exactly these two approaches, breakouts versus moving averages. Similarly, Ken Tropin's Graham Capital, one of the world's leading CTA firms, has published several insightful papers exploring how professional managers identify and capture trends. Again, their work also highlights the same two pillars: the steady signal-driven momentum captured by moving averages and the explosive threshold-based shifts captured by breakouts. So in a way, I'm not really reinventing the wheel here. These methods are foundational to trend following, time-tested, data-driven, and battle-proven across decades of market cycle. That's why we chose them. That brings us to the next and perhaps the most important question. Do time frames of analysis really matter? By time frames, I mean daily, 4-hour or even 1-hour bars. Some people call them time intervals or data intervals. But all they refer to is the same thing: the frequency at which you look at market data. Now, in most books on trend following, time frame selection is treated as a matter of personal preference, something you pick for convenience, not as a parameter that can truly change outcomes. But I found that approach unsatisfying. Except for the book Technical Analysis Using Multiple Time Frames by Brian Shannon, it also barely scratches the surface, but it plants an important idea: the power of looking at markets through multiple time frames. Shannon talks about aligning higher and lower time frames so that your trades move with the broader tide, not against it. Later, while reading the book Inside the Black Box by Rishi Narang, that concept really clicked. He makes a simple but profound point. What looks like trend on one time frame might appear completely mean reverting on another. That's when it hit me. Time frames aren't just about convenience, they define perspective. So when we build or test a trading system, it's not enough to pick one time frame and run with it. We need to test a system across time frames, compare outcomes, and understand where the edge truly lies. Later, when I present the data for 3 different time frames, daily, 4-hour, and 1-hour, you will notice the difference for yourself. So we've spoken about 2 fundamental building blocks of creating a trend following strategy: trend identification method and time frame analysis. Now let's get to the interesting parts, that is the backtest. A fair disclaimer, this is not a recommendation to trade any of the backtests or simulations that I share. These examples use spot prices and are discussed only for illustrative purposes. Over to the backtests. The instrument or index I am testing is Nifty Spot. I will be testing all of this on 3 different time frames: daily, 4-hour, and 1-hour bars. Across these time frames, we will apply EMAs and Supertrend to separately compare their performance. The data here is from 2015 Jan to 2025 October. Let me give you a quick example of how these strategies are defined. For the EMA, we go long when the price closes above the EMA and continue holding the position as long as the price stays above it. We go short when the price closes below the EMA. This setup is known as an SAR or stop and reverse system. That means the exit for a long trade is also the entry for a short and vice versa. The system is always in the market, switching direction whenever the signal flips. With Supertrend, the logic remains similar. Only the reference point changes. Instead of the EMA line, we use the Supertrend bands. If the price closes above the upper band, we go long. If it closes below the lower band, we go short. We will use a similar logic across all time frames. The look-back period for EMAs would change, of course. Let's start with the daily time frame. For daily bars, I use a 8-period EMA, and in Supertrend, I use the default 10-3 parameters. Since Supertrend is a volatility-based indicator, the look-back input in it need not match the EMA look-back, hence I use the default 10-3 across for this illustration. In general, the 8-period EMA on daily does a pretty bad job compared to a 10-3 Supertrend. Of course, by now, if you have been watching the episodes of the long and the short, you would know that it makes little sense to look at the short side, especially on daily time frames. So for this one, let's just compare the long only parts. Look at the table from the top. Total PNL speaks for itself, and now look at the average PNL, that's 35 versus 270. That's a massive difference. What that means is, on an average per trade, EMA system makes just 35 points, whereas Supertrend makes 270 points. This happens because EMA takes a lot of trades, 256 versus 44 in Supertrend, and that many trades is not always a good idea, as the system keeps chopping around with many loss-making trades. The only thing good about the EMA system is the return to max drawdown ratio. So it's quite evident that Supertrend is outperforming on almost all parameters on a daily time frame. But what would be the reason for such an outperformance? I think it's because Supertrend adapts to volatility rather than reacting to every price fluctuation like the EMA does. Since it uses the average true range to set its bands, the Supertrend naturally widens during volatile phases and tightens when markets are calm, allowing it to filter out noise and capture only sustained directional market moves. On an index like Nifty, which has a strong long-term upward bias, this volatility-adjusted approach keeps the system invested during the large trending phases and avoids frequent whipsaws in the faster indicators. In essence, Supertrend's strength lies in its built-in noise filter, its ability to stay committed to a direction until a genuine reversal occurs, resulting in longer profitable holds, higher average trade returns, and overall better risk-adjusted performance, but with a higher max drawdown. Now, if you look at the equity curves of both EMA and Supertrend, it becomes quite clear. Let me show you. The blue line trending up is the line representing the long only on daily. Almost no action till 2020 and then it picks up. Now compare this with the equity curve, the Supertrend on daily. Looks smooth, isn't it? More importantly, it picked up the trend much earlier from 2017 onwards with a minor dip in 2020. So all in all, on a daily time frame, Supertrend wins on consistency and risk-adjusted performance, while EMA wins a bit on speed and efficiency, nothing much otherwise. With the daily time frame done, let's now go one level deeper, the 4-hour time frame. Here, the look-back period for the EMA is set to 21. Why 21? Because it maps to the same 1.5 week duration, similar to the 8-period look-back on daily, and the Supertrend parameters remain the same at 10.3. Here, I want you to see both the long-only and the short-only sections of the table. On the 4-hour chart, the absolute P&L for longs may appear higher at first glance. But what truly matters is the average P&L per trade. 48 for EMA and 153 for Supertrend. This is where Supertrend clearly leads, mainly because it generates fewer trades. On the long side alone, EMA triggers nearly 4 times as many trades as Supertrend. Once you factor in transaction costs, most of the EMA's apparent edge may disappear. Interestingly, as we shift to this lower time frame, the short side starts turning profitable, particularly for EMA. Look at the table. While the short trades on Supertrends are in negative of close to 4,000 points, EMA-based shorts are slightly positive at 700. That's because EMAs react faster, and in Nifty, short trends tend to be sharp and swift, giving EMAs a natural advantage there. When it comes to drawdowns, Supertrend still shows higher max drawdown compared to EMA, but the gap between the two narrows significantly. On the daily chart, Supertrend's drawdown was about 70% higher, whereas on the 4-hour chart, it's around 20% higher compared to the EMA. Also note how the total points captured increase as we move to a more granular time frame, a sign that shorter time intervals can pick up more market movement, though often at a cost of higher trade frequency. Now let's look at the equity and the drawdown charts for EMA. It is slightly more smoother than the Supertrend. Look at the period post-2024 especially. This smoothness comes from the faster reaction time of EMAs. As you can see, the drawdowns in the Supertrend on 4-hour period are more deeper. All in all, if you are exploring the 4-hour time frame, you may have to drill down deeper to analyze the year and month-wise returns and the average P&Ls and then find a sweet spot. So we are now done with the daily and the 4-hour bars. Now let's move to the 1-hour time frame. Among the three, this is the fastest time frame that we are going to look at. Here, the EMA uses a 50-period look back, exactly what I track in our weekly market metrics series, while the Supertrend parameters remain unchanged at 10.3. Let's start with the tables. On this time frame, we will compare all the three: long plus short, long only, and short only. Now, the key difference between the two on this time frame lies in the gross P&L points, that is the total P&L. On that metric, EMA definitely takes the lead. However, when we focus on the average P&L for long-only trades, Supertrend still outperforms, but not as much as it did on daily. Same on win rate. Supertrend offers a way better win rate for a trend-following system compared to the 50-period EMA. 42% versus 29% makes a difference on the margins. Where things get really interesting is on the short side. Here the EMA clearly wins with 4,700 points versus 1,400 points on Supertrend. Because it reacts faster and on a 1-hour time frame, short trends in Nifty tend to develop and fade quickly. The EMA's responsiveness helps it to capture those swift downward moves far better than Supertrend does. If you want to see that difference, look at the equity and the drawdown curves chart. You'll notice that the gap between the long-short and the long-only results is much wider for EMA. That tells you something simple but powerful. The value added by the short trades in Supertrend is almost negligible, whereas for EMA, the shorts contribute meaningfully to overall profitability. You can look at the short-only equity curve as well, the green line in the Supertrend version. It tends to give up on the gains more often than not. Now that we've compared EMA and Supertrend across 3 time frames, daily, 4-hour and 1-hour, you might be wondering what exactly is the conclusion here. Well, there's no one answer. But what I can offer is a framework, a way to think about it systematically so that you can decide for yourself which model fits your trading style best. Now let's go back to the key ideas we started with: the time frame of trading and the method of capturing trends. Talking about time frames, you'll notice that as we move to lower time frames, the gross P&L increases. Now that's an important insight. One possible reason is that maybe a large part of the trends often unfolds intraday, in what is called an impulse leg, the first strong move of a trend. Another factor is that market corrections and crashes tend to start during the day and continue over to subsequent days. An hourly system can therefore help exit long trades faster, protecting profits during sudden drops. And that, I think, makes a huge difference. Slower time frames like the daily chart often miss this early momentum. Of course, this behavior can vary from one asset to another, depending on how its intraday price action tends to be. But in our case with Nifty, shorter time frames clearly seem to capture more of the trend. Now let's turn to the two indicators we used, EMA and Supertrend. Here's what stands out. In certain contexts, like capturing the short side trends, EMA performs better because it reacts faster. But for long side trends, Supertrend often comes out ahead. It takes fewer trades and gives each position more room to breathe thanks to its volatility adjustment. So maybe the final choice depends on what you want to capture. If you want to play the long only game, Supertrend might suit you better. But if you want to include short trades, EMA gives you that extra edge. Or perhaps the best approach is a blend of both, combining the stability of Supertrend with the agility of EMA. But here's the thing, don't take any of what I shared as gospel. I just shared an illustration with you all. On top of that, if you tweak the lookbacks, add buffers to reduce the trades, especially for EMA, you may be able to get better results than what I shared. Same with Supertrend as well. I'll leave that work to you. And that brings me to the end of this part 2 episode on trend following. I hope you found these ideas useful. If you have any questions, drop them in the comments and I'll do my best to answer them. In the next episode, I'll focus on the idea of trend following across two uncorrelated assets, Nifty and gold. And yes, don't forget to subscribe to this channel. See you in the next episode of the Long and the Short Show. Till then, trade safe and stay curious.